Can you still retire in a down market? With the stock market being down, inflation on the rise, that is a question on a lot of minds. Stick around for today's episode where we're going to talk about the factors involved in making this decision, and then the one thing that this primarily revolves around, plus how we've helped others just like you determine the answer to this question.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of the Your Life, Your Money podcast, where we discuss thoughts, strategies, and actions to help you thrive in life, wealth, and your retirement. I'm your host, Scott Searins, and in today's episode, we're going to be answering that question, or helping to answer the question, can you retire in a down market? So whether you retired last year, whether you're looking to retire this year or 2022, or potentially staring at retirement next year, I'm sure this thought is on your mind as you're seeing the articles out there about being in a bear market, the stock market being down. Is there a recession coming? And I realize this can create some worry. This could potentially create some anxiety in the questions going through your mind. And you might be sitting there thinking, I just am ready to retire. I'm ready to be done at work. But now that the stock market is down, can I still retire? Can I still make this happen? Can I still make my money last through retirement? And we're going to be talking about why it may or may not be difficult to retire in a down market. And then what does all of this revolve around? You know, we're going to talk about a lot of factors in answering that question of can you retire in a down market, but you'll find that it primarily revolves around one thing. So stick around to find out what that one thing is. And I've hoped that you found our podcast to be of value and benefit, or if this is your first time listening, welcome to the podcast, and I hope that you find this episode to be of value and benefit to you. And if so, and you want additional information to help you continue to build wealth, live a great retirement, or understand how to reduce your long-term tax picture, that's right. My goal is that for all of our clients, that they only pay the taxes that they legally have to, but we don't want to leave the IRS a tip. And so if that's you, go to our site, lifemoneyshow.com. Again, that's lifemoneyshow.com, and sign up to be part of our insiders list, where you'll continue to receive weekly emails with actionable thoughts, strategies, and ideas to, again, help you build wealth and reduce your long-term tax picture. All right, before I dive into the question, yes, we are in a down market in 2022. And I realize that there is a lot of interesting news out there, news talking about recessions, news talking about bear markets, and this can create a lot of stress. Sometimes it can create anxiety. Sometimes it can create worry. And so I thought I'd try to pick one of the positive articles that I saw out there right now and bring that up. Now, whether this person's right or wrong, I'm just always trying to find the positive as we're sometimes going through these down markets. Because remember, it's the long-term focus that helps us towards our financial success. But we don't want to let short-term perspective ruin our long-term results. And the article was actually from Business Insider. It said, Wharton professor Jeremy Siegel says that the S&P 500 has likely already priced in a recession, so we're closer to the lows than the highs. So what does he mean by that? Basically, he feels that stocks are close to the bottom despite ongoing volatility that we see, meaning he feels like it's already priced in the recession. I get it, right? Nobody's actually called that we're in a recession. And that's the thing here. He feels that the stock market, and we've talked about this before, the stock market reacts in advance. So he feels that the stock market is already reacting and pricing in what he says is a mild recession, and that it's already pricing that in. Now, is he correct? We're not sure. We'll find out as time goes on. Is he wrong? We're not sure. We'll find out as time goes on. But I thought that was just a very interesting article. So as we continue to go through here, one thing, and I'm just going to pull this, my thoughts, right, my opinions out of this article, that's a good reminder, is that the stock market sometimes acts in advance of what's actually going on in economic conditions. So if you look at past recessions, when the recession was finally started, right, and when the recession was over, the stock market sometimes was already on its way back up. So while things were very difficult personally for different people or just from an economic standpoint, the market had already rebounded and was on its way back up. And that's really interesting for us to understand too as we go through today's conversation about can you retire in a down stock market. So what brought this up? Well, I was reading a couple articles here that, and again, all of the articles, the Business Insider article and the two articles I'm going to talk about today as well as my thoughts. You can find all of this in the show notes. You go to lifemoneyshow.com. Again, that's lifemoneyshow.com. That's not only where you can sign up for the insiders list to get our weekly emails, but you can also find the show notes, and I'm going to link to all of the articles. But there's two articles that I was reading, and the headlines, I could see how if you were planning, again, the question that we're talking about today is, can you retire in a down stock market? And I could see how these articles could bring nervousness to a person who is looking to retire, could bring worry. The one article by CNBC said why 2022 has been a dangerous time to retire and what you can do about it. The other one from the Motley Fool, it was, should you go ahead with your retirement plans if there's a stock market crash? Now, as I mentioned earlier, there's a lot of factors that go into planning your retirement and understanding if you can still retire. However, you'll find that these primarily revolve around one factor. And as I go through here, what I want to start with is why, what these articles talked about of why or how it could be difficult to retire in a down stock market. And so first, let's start with that. And as I go through, see if you can figure out what that primary factor is. So starting with the article from CNBC, I'm just going to go through a few points here of why they say it might be, in their words, dangerous to retire in a down stock market. First off, they talked about in today's economy right now, stocks have plunged this year. They said bonds, which traditionally serve as a ballast when stocks falter, have also been pummeled. So right now, we're in a really unique time where both stocks and bonds are down. The S&P 500, the measurement of the 500 largest stocks, again, you can't invest directly in an index, but it is a good measurement of the 500 largest stocks in the United States to kind of guide and tell us what's happening in the stock market. The S&P 500 is down. If you look at the a bond aggregate index, the bond index is down. So we're in a unique time where you would go to bonds for safety, right? We're in a unique time where both of those are down. The point here is when both are down, now you've got to go and make withdrawals from two different asset classes, which are both down, where typically bonds have been that safety net, right, from stocks. Now, have bonds gone down as much as stocks? They have not. At this point in time, it doesn't mean that they couldn't, but at this point in time, they have not. And they've been a little bit less volatile than stocks. And if you look at history, bonds have been less volatile than stocks throughout history. Point number 2 of why or how a down stock market can make it difficult to retire is what they were talking about right now. We're seeing high inflation. So high inflation, their quote here, high inflation also means retirees need to draw more income to afford the same items to make ends meet. Point number 3 that they talked about here is the sequence of returns risk. And if you haven't heard of sequence of returns risk, I'm actually going to point you again, lifemoneyshow.com. Go to the show notes, go to the article. They give a very good example of sequence of returns risk. But when you are accumulating money, meaning when you are saving and investing, you are not impacted by sequence of returns risk. Very high level, it just means in which order are the returns coming, meaning potentially this year you're down 30%, next year you're up 6%, the following year you're up 20%, the following year after that you're up 30%. That's one sequence. But what if the sequence was in the opposite order, where the first year you're up 30%, then you're up 6% and 20%, and then the fourth year you're down 30%, right? So that's the sequence that the returns come to you. And that sequence is important because if in your first year in retirement, that year is a negative year, it could potentially impact your future income stream. So what they said here is someone who withdraws money early in retirement from a portfolio that's declining in value is at greater risk of depleting their nest egg too soon, relative to a retiree who suffers a market downturn years later, meaning 5 years later, 10 years later, 3 years later. But that first year can be very important in that risk. Because think about it this way, and here they're going to give another little statement here, and I'll give you an analogy. It says, when the markets pull back, it means investors need to sell more of their investments to generate income. That depletes savings faster, leaves less of a growth runway when things rebound, hobbling a portfolio intended to last for several decades. Let me just put this into just basic terms here. I want you to think about a spring. Has anybody ever undone a pen, right? So you've undone the pen and there's the spring in the pen. Think about this. If you were to take that spring and compress it with your two fingers and then you let it go, right, it comes back to normal. Now say you were to take that spring and compress it, and at the same time you cut off parts of the spring. That would be like your retirement withdrawals. Now when you again, let go of that spring, it's not going to go back to its full normal length, right? Because you've cut off now some portions of that spring. So think about it, think sequence of returns risk that way, is that right now we're in a compressed market. So we're in a compressed spring. The more withdrawals or the more that you cut off of that spring while it's compressed, gives it less to bounce back up to its normal length. Hopefully that's a good kind of a just simple analogy there for you to help understand the sequence of returns risk. Again, go to lifemoneyshow.com. They've got a nice little example written out in their article there if you're looking for further explanation on sequence of returns risk. So between the two articles, there was 3 main points there, right? Having to make withdrawals when the markets were down, inflation being up, meaning you might have to spend more, and then the sequence of returns risk, which could impact your future withdrawal or income needs that you can take from your portfolio. So have you started to determine or kind of recognize, while there's a lot of factors going on here, have you started to recognize that one thing that this all revolves around? And I'll give it to you here. That one thing that this all revolves around is how much that you're going to need to withdraw to live your lifestyle. This is what I call your income gap. Meaning, we all have a lifestyle that we need to maintain. Now, some of that lifestyle has, I'll say, non-flexible income that we need to maintain our, pay our mortgage or pay our rent or make sure we can pay for the utilities, and we need groceries, and we need, just the basic lifestyle needs of what it is to live. And then there's maybe non-discretionary portions of our lifestyle, which are the vacations and the extras and the other things that we want to do. But hopefully you can see all of this primarily revolves around those income needs. And so whatever that number is, maybe you need $7,000 a month to live. Maybe you need $5,000 a month to live. Maybe you need $9,000 a month to live. But whatever that is, right? And then you subtract out how much you might be collecting in Social Security and how much you might have coming in from a pension or from rental income. And then there's going to be a difference there. And that difference is your income gap. This is what it all revolves around. So now to go into helping to answer that question of can you retire in a down market? Well, first and foremost, understanding those withdrawal needs. And once you figure out that income gap, does your portfolio support it? Here's what I mean, and let's kind of think about it in this analogy. Let's just say you're making a driving trip. I'll tell you what, I love to go and visit and hang out with my parents, and they live about 2 hours and 15 minutes away. But here's another way to look at this. It's about a quarter of a gas tank, right? And I know on that, to get from here to there, to get from my place to their place, I'm usually going to stop to eat. I typically, I push the limits a little bit. I might go a little bit over the speed limit, so I'm not getting as great of gas mileage as I could if I'd probably go the speed limit or a little bit less. So I'm burning some fuel that way, right? I'm going to stop to eat food, so I'm taking going a little bit out of the way, costing a little bit more in gas that way. And sometimes I like to stop at the rest area too, just take a little bit of a break. But doing all of those things, right, I know it takes a quarter of a tank to get from point A to point B. So here's the thing. Do I typically just fill up a quarter of a tank to go there? No, I usually have got a half a tank or a full tank to get from point A to point B. Well, think about the same thing here when it comes to your retirement. If your tank was just enough to get you from point A to point B. So in relation to my driving example here, if you were just on a quarter of a tank and that was going to get you through retirement and that's it, but now all of a sudden we're in a down market, down economy, well, then you may not have enough to retire. Or you're going to have to make some adjustments, and we'll talk about those adjustments in just a second, right? Because it might have been like driving 10 miles over the speed limit instead of 5 miles per hour over, or that there was an accident on the road costing more fuel out of that tank, and you're not able to get from point A to point B, meaning you don't have enough in the tank to make the withdrawals that you need to make to get you through retirement. Or maybe in your scenario, what you actually needed to get through retirement, the withdrawals that you needed to make to get, take out of your tank was like me driving to Anawan, meaning you already had 3/4 of a tank, 3/4 of a tank of fuel, and you only needed a quarter of a tank. So doing some retirement income projections and comparing that to where your portfolio is now, even though the market is down, you might still have a surplus of funds, meaning that you can still retire because you have enough in your fuel tank to get you from point A to point B, meaning you have enough in your investment portfolio to get you through retirement. Hopefully that analogy helped a little bit in regards to the first question to ask yourself is, one, understanding how much do you need to withdraw from your portfolio, and is there enough in your fuel tank to get you through retirement? If there is, and if you still had a surplus, great. I don't see any reasons why you couldn't retire in 2022. If you just had enough in your tank to get you from point A to point B, you weren't leaving any surplus, you didn't have any flexible room in case there was that accident, in case you needed to make a second stop for food, in case you're just driving a lot faster or a lot slower, well, then there's some other things that you can look at and consider in regards to retiring early. So let's talk about this here. One is you can potentially look to reduce your spending. And I'm going to talk about a system that we use with our clients in understanding, retirement income and retirement income spending. And then the other is structuring where those withdrawals come from. Talk about that as well. So first and foremost, these are items that I would highly, highly recommend for anybody listening to this podcast, just for information, just to continue to gather and make sure you're on the right track. If you're not looking to retire this year, these are things that you want to put into place at least 5 years in advance of your retirement. So that way, when it comes to times like these, you already know whether or not you're going to be retiring, you're able to retire or not. One is what I like to call income guardrails, meaning understanding at each point in time how much income that your investment portfolio can produce. And think about it like this, and I think this is what people are feeling right now. This is the worries that they're going through. A lot of people look at retirement income and retirement like driving over this really long, narrow bridge. Think about a bridge that would only fit your car. That's it. Now imagine that bridge without guardrails. Does that feel like retirement to you, right? Like you've got one shot to get across that bridge, but if the market goes down, it feels like you're falling off the bridge and everything's going to fall apart and you're going to crash and burn, right? And so it's like, well, what do I do? And so sometimes a lot of people, instead of even trying to get over the bridge, right, they just sit on the one side, meaning they don't spend their retirement portfolio. They just sit there and let it grow because they're too scared to spend it because they don't want to run out of it. They don't want to fall off the bridge. However, hopefully we all know that's not how bridges are constructed. So imagine again that nice bridge, and we'll just say maybe it's got some width to it now. Now it's 2 or 3 cars that can get over it. But what are they going to have on the edges of that bridge? Guardrails. And so that is how we look at retirement income. One is picking a withdrawal number that we feel should hopefully get us across that bridge, meaning something that we feel nice and comfortable about taking withdrawals, an amount that we feel that we can take withdrawals to help supplement your Social Security and your pensions and any other income that you have coming in, of what's going to get us across that bridge. But in the event of a down market, just like we have today, right, we're not going to fall over the edge of the bridge. We're going to hit the guardrail. And when we hit that guardrail, it's not shutting off the faucet. It's not turning everything off. It's understanding what kind of reduction do we need to make to continue to make the money last through retirement. But here's the other part, and the good part about this is that history has shown us that the market has rebounded, the market has come back, and understanding that what if we hit the guardrail on the other side of the bridge, meaning the market's gone up, and when we hit certain parts of growth in our portfolios, when can we increase the withdrawals, the income that we're taking from our portfolios? So implementing an income guardrail system can help you understand, again, can you retire today? So at today's value of your portfolio, how much income can be withdrawn? And based on that, is that enough for you to live your lifestyle? Or based on if the market rebounds and where you see that it'll go up to, is that enough that it'll give you not only I'll call it the non-discretionary spending, but also that discretionary spending of the vacations and lifestyle that you want to live? So understanding your income guardrails. The second part is structuring where the withdrawals come from. Now, this is something that we do with all of our clients as they start approaching retirement. But if you're looking to retire this year or next year, then this is something you have to kind of work through. Hopefully you've already started this, but you might want to structure where your withdrawals come from. We talked about that sequence of return risk. Remember earlier I talked about that spring, right? And taking withdrawals from a spring while it's compressed doesn't allow it to bounce back to its full length. Well, what if instead of taking the withdrawals from that compressed spring, you're able to take withdrawals from a cash position or a more safer position? Sometimes people use bond funds, sometimes people use annuities, but a more safer position to take that withdrawal from while you let that stock or equity spring rebound and bounce back up. So that's another thing to look at to understand, hey, can you retire today? Do you have an alternative location to go and take your short-term withdrawals from while that spring bounces back up. For anybody that's listening that's not looking to retire today, this is something that you really want to start putting into plan, right? Into your plan. I would say at least 5 years in advance of your retirement is starting to carve off these other asset classes, these other asset categories. You don't want to have everything fully in equities. You want to start carving off these safer positions so that way if we do have what we're having today, that down market, you've now got that safer position to go to make those retirement income withdrawals while the equity portion, your equity spring that's compressed, bounces back up. Okay, a few other things that they've mentioned in the article, and I think that's just important to bring up too, of wondering, can you retire in a down market? Well, maybe you look through, again, point one, does your investment portfolio still support it? Maybe you look at that and go, well, it doesn't. Then you put together your income guardrails and you say, yeah, I'm just not comfortable with these income guardrails, right? Meaning the income that you can take today, where you might have to take future and further reductions, but also where your potential growth might be. And you didn't have that position of cash sitting aside to be able to make short-term withdrawals from, then maybe you do need to work longer. And that is an option to consider. If you're still working, you haven't made that full retirement decision yet, just working and letting your investments rebound and come back up some can make a huge difference in that retirement, in that future, and helping to make your money last. Another thing, maybe is delaying your Social Security. Maybe you're going to retire this year, take Social Security, and start making the retirement income withdrawals. But if you can figure out a way in your portfolio and your income, maybe taking a little bit extra from your portfolio right now, even though it's down, I know I'm really not suggesting doing that, but if there's a way for you to delay that Social Security, right? Because every year that you delay your Social Security, you're getting an 8% increase until age 70 where you have to take it. But that's a really nice increase, plus all of the cost of living adjustments are based on when you take your Social Security. It's like having a lifetime pension. It's like a lifetime annuity with cost of living adjustments. So delaying claiming your Social Security could potentially help you in making that decision whether you can retire right now in a down market or not. Then the other part that I would just suggest is, let's say you put things together and you're like, wow, I think I can still retire today in a down market. Everything's working out. I had enough, I'll call it surplus in my fuel tank, right, to get me through retirement based on the income that I need. One thing that I would still recommend is stress testing your plan. Going through the what ifs of life. Back to my driving analogy. What if there was an accident and you had to sit on the road for an extra half an hour burning some more of that fuel? Would you still have enough in that fuel tank to get you from point A to point B? What if you stopped 2 more times to go to the bathroom and grab some food? What if? So in your scenario here, what if the market continued to go down? What if you were 10% wrong on how much income that you would need to withdraw from the portfolio, or 20% wrong? What if you needed a large lump sum in 5 years of, $10,000 or $20,000? Go through those what if scenarios, and if you get through those what if scenarios and it still works out, great. Feel comfortable retiring in a down stock market. However, if your plan is too close, meaning you get through everything and after the what ifs, you're just like, yeah, boy, that's going to put us in a position where we won't be able to maintain our comfortable lifestyle, then your plan might be a little bit too close. You might not have enough surplus in there, and you might not be able to retire in a down market. So, again, a lot of factors here. Let me just recap them really quick. Understanding what is your income gap, how much income or how much in withdrawals you're going to be needing to make from your portfolio, comparing that to your portfolio. This is a retirement income plan, and understanding, does it still work out or not? If yes, great. You had surplus in your fuel tank. that's great. You can still retire in a down market. If it's close, going through the next parts, right? Understanding, do you need to reduce your spending? And if you reduced your spending, could you still make it all work? Plus, where are your future income guardrails at? And will that work? If the market continues to go down and you need to reduce your spending some more, will that still work for you or not? Structuring where the withdrawals are coming from. Do you have, right, different buckets set up? Do you have your cash bucket? Do you have your war chest bucket? Do you have your growth bucket? Because the cost of goods and services will still go up. So even though the market's down, which can make it totally scary to be in equities and stocks, we're going to need that growth for the future to help you keep up with the cost of goods going up. Potentially working longer, delaying Social Security, and then stress testing your plan. A few things here. One is that I want you to think about this. If you go through testing out your plan and you have enough income in this down market, right? Just think about this. Having enough income in a down market, to me, is a positive thing because it means that you will have even more if and when the markets rebound. So you're in my eyes, even though you're looking at this as a scary situation, if you do have enough today, most likely, based on history, things will only get better from here. So good news. The other is, remember this, we're all in it for the long term. I know a lot of times we can just get really focused on this year, but we need our dollars and money to last multiple years. So yes, we still need an equity position out there because we're going to need growth in our portfolios to keep up with the cost of gas going up and groceries going up and travel going up. And to remember that we're going to see multiple events like this throughout that next 10, 20, 30 plus years of your retirement. I hope that you found this podcast to be of value and benefit. I hope it helped you understand the factors that go into understanding whether or not you can retire in a down stock market. So if you found this to be of value and benefit, first off, subscribe to the podcast on your favorite podcast player, whether that's Stitcher or Google or Spotify or on Apple. Subscribe on your favorite podcast player so that way you get notified as we're continuously coming out with additional podcasts to help you build wealth and reduce your long-term tax picture. Speaking of that, if you're looking to keep more of your hard-earned retirement savings in your pocket versus giving it to the IRS in taxes, subscribe to be on our insiders list. You can go to lifemoneyshow.com. Again, that's lifemoneyshow.com. You scroll down, put in your name and email address. Being on our insiders list, you'll get weekly emails with actionable thoughts, again, strategies, actions that you can take to help reduce your long-term tax picture and make sure that you're on track towards financial independence and thriving in retirement. I look forward to our next conversation to continue to help you live life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.